Public debt in advanced economies now averages near 120% of GDP, according to the IMF. At these levels, the playbook for central banks changes. The focus shifts from managing inflation to managing the risk of default and systemic collapse. Governments face a stark reality. With debt this high, history offers only two real options: default or inflate the debt away. The political costs of outright default are severe, so policymakers often choose the less visible path. Controlled inflation, kept just high enough to erode the real value of debt, becomes the preferred tool. This isn't a new idea. After World War II, the US relied on financial repression, with the Federal Reserve holding interest rates below inflation for years. According to the IMF, this approach helped reduce the US debt-to-GDP ratio by over 50 percentage points, mostly by allowing inflation to outpace returns on government bonds. The scale is different now. Today's debt burden, relative to GDP, far exceeds the post-war era. Central banks in the US, Japan, and Europe all face what economists call fiscal dominance, where the need to finance government deficits shapes monetary policy decisions. The Federal Reserve, for example, kept rates near zero from 2008 to 2015 and launched multiple rounds of quantitative easing, expanding its balance sheet by over $3 trillion between 2008 and 2014. Each crisis brings more intervention, not less. COVID-19 stimulus alone doubled the Fed's balance sheet in just 18 months. The mechanics are straightforward. When inflation runs higher than interest rates, the real value of debt shrinks over time. A 2% inflation target isn't about true price stability. It's the minimum needed to prevent debt from becoming unmanageable. When inflation spiked to 9%, central banks hesitated to raise rates aggressively, revealing the bind they're in. This dynamic creates a system where governments, corporations, and households are encouraged to borrow more, all relying on the expectation that central banks will keep money cheap.